Hello and welcome back to Wealthy for Real. When starting to plan for large purchases or financial goals, one of the first things that people often start paying attention to and working on building is their credit score. But what is credit? Why do we have a credit score? And why do we put so much emphasis on trying to get that number as high as we can? The term credit refers to a person's ability to borrow money from a lender to be paid back over time or at a later date, typically with an additional fee attached called interest. A person's credit score is a number between 300 and 850 that's assigned to them and can be used to let any potential lenders know how much of a risk that person may be as a borrower. There are many different credit scoring models that are used to calculate different scores, but the credit score that most lenders use to check your creditworthiness is called your FICO score. And there are 5 factors that go into determining your FICO score that you should focus on when trying to increase that number. Those 5 factors are your payment history, your total amount of debt, the length of your credit history, your credit mix, and the new credit that you have recently applied for. Let's start with payment history, which accounts for the biggest chunk of your credit score, 35%. When it comes to calculating your credit score, this looks at your track record of how you've paid or haven't paid debts in the past. This includes payments that were 30 days or more late, any of your debts that have gone to collections, if you've had a foreclosure, or if you filed for bankruptcy. Whenever you want to start working on improving your credit score, this section is the first and most important to tackle. If you have a history of paying bills late every now and then, you must start making it a point to pay on time. And any debt payments that you are currently behind on, try to work to getting them up to date as soon as possible. The longer you go without paying debts, the bigger the outcome it has on your credit score. If you have payments that you don't think you can keep up with, or that have gone to collections already, you'll want to contact your creditor and try to negotiate a smaller payment, lower interest rate, or agree to pay a fraction of any debt that you currently have in collections if possible. Be sure to get any new terms that are agreed upon in writing. The next largest factor that goes into determining your credit score is the amount of debt you have, which accounts for 30% of your credit score. This looks at the amount of debt you owe on all of your accounts and your credit utilization ratio. Credit utilization is the amount of money that you owe currently divided by your total credit limit. So if you have a total credit limit of $5,000 and you have a balance of $2,500 of unpaid debt, your utilization ratio is 50%. It's best to keep your utilization as low as possible, but aim to at least have it remain under 30% at all times. After making sure that your payments are up to date, focus next on paying down as much outstanding debt that you have as possible, as this will greatly help in improving your score. The third most significant factor in determining your credit score is the length of your credit history. This chunk of the credit equation that makes up 15% of your credit score takes into account the age of your oldest credit account as well as the average age of all of your accounts combined. The longer the amount of time that you've had credit being reported to the bureaus, the higher your credit score will be. This is the reason why you don't want to close your accounts once you've paid off any credit cards. If you have a hard time with discipline when it comes to charging up your credit accounts, it's best to burn, freeze, cut up, or destroy your credit cards in the best way you see fit that prevents you from charging up even more debt on it. But do not close that account. Next up is your credit mix, which accounts for 10% of your credit score. This measure looks to see if you have a good mix of the different types of credit accounts that exist. Types of credit accounts include installment, revolving, and open accounts. Installment accounts are accounts like a mortgage or an auto loan where you've borrowed a set amount of money to be paid back monthly with interest until the loan is completely paid off. Revolving accounts include things like credit cards or lines of credit, where you are granted a limit on the amount of money that you can borrow at a time, and you can spend up to that limit and pay the balance back down indefinitely. Open accounts are a less common type of account reported to credit bureaus, but they include accounts that you're contracted to pay monthly in exchange for a service or an item. These type of accounts can include a cell phone account, rent payment, or streaming services. The final factor that's used in calculating your credit score also makes up 10%, and that is how much new credit you've recently applied for. If you've ever heard the term hard inquiries, this is what was likely being referred to. Whenever you apply for new credit, the lender usually does a credit check on you to evaluate your credit worthiness before they agree to lend you the credit. That credit check can negatively affect your credit score for at least a year and stays visible on your credit report for 2 full years. Now you may hear that and be thinking, well, how am I supposed to shop for the best terms and rates if every inquiry is a strike against me? Great question, and there's an even better answer. The different credit score models allow for a short window when you're rate shopping before applying for a loan. This means that if you're applying for a mortgage or an auto loan and you shop for rates with several different lenders within a specific time period, your multiple inquiries will only count as one when accounting for the effect on your credit score. The length of the window is typically between 14 and 45 days, depending on the particular credit scoring model being used when calculating your credit score. Since you never know which version of your credit score a lender may pull, it's safest to do all of your loan shopping within 14 days of each other so you stay within that window across the board. With that said, if you made it this far through the video, thank you for watching. I'd also love to hear from you. Did you learn anything new about how your credit score is calculated that you didn't know or hadn't considered before? If so, leave a comment below and let me know your thoughts. Also, if you did find any value from this video, please go ahead and hit the like button below. If you'd like to continue seeing similar content on how to begin taking control of your financial situation, subscribe to this channel to see more videos on small steps you can take now that will help you on your journey to becoming wealthy for real.